recording. And I thought it might be helpful because last time we finished speaking about stock splits, and I think it was Kenya who asked if there was a question on stock splits, and I was saying that it doesn't really come up as a separate example. It might just be something like a multiple choice question or whatever. But so I did just go through the textbook a little bit to see if there was a way that I could show you guys how how the stock split comes up in a question. So I found this problem 14.1a, and we're not going to do the whole problem. I just wanted to show you that there is a piece about a stock split. So I'll read kind of the preamble and set this up. And then what I want us to do when we look at this, the stock split piece, is for you guys to actually think on your own what the implications are of the stock split. So on January the 1st, 2020, Jeffrey Corporation had the following stockholders' equity accounts. So they had common stock. The shares have a $20 par value. They had 60,000 shares issued and outstanding. So obviously the number of shares times the par value then gives you $1.2 million, right, in the common stock account. Paid in capital in excess of par on the common stock is 200,000. And then they had retained earnings of 600,000. So if we just focus our attention on April the 1st, it says that they announced a 2-for-1 stock split. Prior to the split, the market price per share was $36. Now, if you think about our example that we had with Apple in the last class, remember we spoke through what that would mean. So I don't want anybody to shout out any answers, just work silently on your own. I'm going to give you 3 minutes to think through what happens to the stock price, and if anything, what happens to the par value and the number of shares in this case. All right, so go ahead and try to figure out the answer to this. And I guess the last piece is, will there be a journal entry or not? And again, please don't shout anything out. Let's give everybody a chance to try and figure this out on their own. Okay, you have 1 more minute. All right. Does someone want to take a stab at this
Yeah.
to tell us what you think? Someone said yes, so go ahead.
So the par value goes down to 10.
Okay, so because it's a 2-for-1 stock split, yeah, for every one stock that you have, you'll now get two. So yeah, you're correct. So if you have one stock of $20, you'll now have par value, excuse me, you'll now have two stocks of $10 par value each. So I'm just gonna write that. Let me see if I can make a space here. Um, and just write this here so that people, so this was for P14.1A. So the par value goes down to $10 per share. Good. What else?
And then the shares outstanding will be 120,000.
Okay, good. So shares outstanding were 60,000, but because for every one stock, you're now going to have two, it's to double. So shares issued and outstanding becomes 120,000 at 60,000 times 2. And this was $20 divided by 2. All right, what
And
else?
then there is no journal entry.
There's no journal entry, that's correct. And what happens, there's one more thing. What happens to the market price? The market price that was $36.
It goes down.
Mm-hmm. So the market price also has to halve, right? Market price goes down to $18 per share. So it's $36 divided by 2. So because we're doubling the number of shares, the shares go up to 120,000, but you can't keep the $20 par value because then the number becomes too big, right? It will become 2.4 million. So you have to halve the par value so that it stays the same at 1.2 million. Also, the market price can't stay at $36 because then, you're doubling up the shares. There's no way the price is going to stay at $36. So it goes down, it halves to $18 and no journal entry. All right, so that's the way we think through a stock split. Any questions there? Okay, so there's not much else that I can say about a stock split. You follow this approach. So if you do get a part of a question that's talking about a stock split, or you get a multiple choice question that's talking about a stock split, this is how you think it through. And I used, the one transaction from P14.1A. If you look in the solution, it will probably just say no journal entry, but it will probably discuss the fact that the par value goes down and the number of shares goes up. Okay, so on Monday, we kind of spoke a little bit about retained earnings and the fact that we have to do, possibly prior period adjustments and so on. So I just wanted to start out again by just thinking about retained earnings. So I just through a T account here for retained earnings. And I want us to just remind ourselves how retained earnings works, right? So the first point is that it's a capital account. So it goes up on the credit side, right? And it goes down on the debit side. And it's a capital account, as I said. So when you think about trying to calculate the balance on retained earnings, which is the next part of this chapter that we're tackling, you want to know for sure and be confident in which side is the increase and which side is the decrease, and also which types of items will increase and decrease retained earnings. So the first thing that increases retained earnings is net income, all right? Net income and retained earnings are related to each other because retained earnings represents all the net income that the company has kept back from all the prior years. So in other words, all the income that wasn't distributed as dividends, all right? So when net income increases, retained earnings increases as well. And this number comes through from that closing journal entry that we did in chapter 13. And so if net income increases retained earnings, it must mean that net loss would be a decrease. So if we had a loss for the year, we would be debiting retained earnings instead of crediting retained earnings. Then the other things that decrease retained earnings, cash dividends. Remember, I told you that we use this account called cash dividends to record a cash dividend, but ultimately that account actually closes off to retained earnings and decreases retained earnings. And the other thing that also, that also decreases retained earnings is stock dividends, right? So even though a stock dividend is a distribution of stock, so you might think, well, we're not distributing cash, so why, would retained earnings go down? You're still distributing a portion of prior period's income. You're just distributing it in the form of stock. Therefore, you need to reduce retained earnings to show that that amount is no longer available for distribution, and you will increase your common stock to show that it was distributed as stock. Any questions up to here? All right. And then we come to this, this error business, like if there was an error in net income in a prior year. So that's what I was talking about the last time, right? We call it prior period adjustments. So basically what happens if we're sitting in 2020 and we suddenly realize that there was actually an error in net income in 2019, and for whatever reason, either revenue or expense caused, errors caused an error in net income. What if we need to fix that, right? So we can't go back and change net income itself because it was already closed off to retained earnings, which means that any adjustment that we need to make for a prior period error is going to be made in the retained earnings account. All right. So how do we know how to treat these adjustments? So retained earnings will go up if there's a prior period adjustment because net income was too low in the previous year. Okay, so for that you'll have to increase retained earnings. And then why would you decrease retained earnings? Because there's a prior period adjustment because net income was too high, right? Was too high in the previous year. So then you subtract from retained earnings whatever the amount of the error is that exists. So like I said, error corrections and things sometimes become a little bit difficult for people to understand because in order to correct an error, you have to know what was done incorrectly, then you have to know what should have been done, and then you have to know how to make the correction, all right? So what I'm writing over here is the how, right? How are we going to correct this? If the net income was too low in a previous year, we will have to add the amount of the correction. If the net income was too high in a previous year, we will have to subtract the amount of the correction. Any questions there? All right. So I did put, I think it's in the Zoom call materials as well. Let me check. I did put a document, about errors on retained earnings. I mean, it's just a kind of a rough write-up that I did of how to handle errors. I'll just go through this and then we'll start doing examples. Not all of the examples have prior period adjustments. So, it's not always going to come up, but I think, you know, the classic parts of retained earnings are not that hard to follow: net income, net loss, and the two dividends. Normally people have problems with the adjustments. So looking again at errors, if the error in the previous year caused retained earnings in the previous year to be too low, we need to credit the amount of the error to retained earnings in the current year. So what does that mean? When net income was too low in the previous year, that means that retained earnings was also too low. So we need to increase retained earnings. All right. If the error caused retained earnings in the previous year to be too high, we need to subtract the amount of the error from retained earnings in the current year. So this is this example. If net income was too high, and maybe I'm remiss, I should probably say when net income, there's a direct relationship here. When net income is too low, retained earnings would also be too low. Okay. Why is this thing so small? Okay, so and yeah, when net income was too high, then retained earnings would also be too high because they have a direct relationship. So that's also why the change has to be made to retained earnings. I hope this is making some sense. Okay, this is a little bit harder work, so you know, no one's asking me anything, which either means no one knows what's going on or it's clear so far. In 2018, listen to this example now. In 2018, we discovered that the 2017 depreciation expense was too low by 10,000. So let me ask there to anybody, if depreciation expense was too low, then what happened to net income? Would it be too high or too low?
Is it too low?
No. If an expense is too low, meaning you should have deducted more expense, then your income will be too high, right? So if I say I was supposed to have an expense of $10, but I only subtracted $6, then it means my income is too high by $4. Does that make a little bit more sense?
Yes.
So the expenses, yeah, we can see it. I wrote for you guys the relationship between expenses and net income and retained earnings. If the expense is too low, net income will be too high because you should have deducted more expenses, but you didn't. So net income becomes too high. They have an inverse, if you remember this from math, right? This is an inverse relationship, whereas net income and retained earnings move in the same direction. If net income is too high, then retained earnings is too high. So because retained earnings was too high, we have to subtract the amount of the error, okay? So here's the same thing. Hint, if expenses are too low, net income is too high, therefore retained earnings was too high, so we need to decrease retained earnings in 2018. So how do we do that? How do you decrease retained earnings? It goes down on the debit side. So you debit retained earnings and you credit not depreciation expense, but accumulated depreciation, because the depreciation expense is already closed. This is difficult, okay? So if you're like, what the heck just happened? You need to ask me questions or I can go over it again. Does someone have an immediate question that you want me to answer or you want me to repeat?
Yeah, can you please go over this?
Yeah. So, do you just want me to go over the whole thing, or is there a particular part where you want me to emphasize?
Where you said that you know, when you were talking about the debit retained earnings.
Oh, the journal entry.
Yeah.
All right. So let me ask you this: do you remember when you record depreciation, right? You normally would debit depreciation expense, right?
Yes.
Do you remember this? Let's just make it 50,000, and you will credit. Where's my thing? Oh, okay, I see what's happening. And you will credit accumulated depreciation,
Yes.
right? Also for 50,000. That's the journal entry when you record depreciation, Okay, this account is a temporary account that will get closed off. It gets closed to income summary, and eventually all of that goes to retained earnings. This is a permanent account, right? So the
Yeah.
temporary account only belongs to that year. It gets closed off. So let's say this is what you did, right? This was the amount that you booked, but what you were supposed to do was this. Right? You should have booked 60,000, but instead you booked 50,000. What does this mean? You're too low, right? By 10,000. Do you agree?
I'm still confused.
Yeah. So by what? By what part? By what I'm doing over here?
Yes.
I want to help you, but tell me
Okay,
where
so
the confusion lies.
I get the part where you said the depreciation expense for 50,000 and how it belongs to the income summary. But where I'm getting stuck is like you said that accumulated depreciation is permanent, right? So when we're recording it in the journal,
Mm-hmm.
how would you record it? That's where I'm
That 50,000, and then you'd send it to the ledger. It's all the same. It's just permanent. Just means that the balance keeps changing every year.
Oh, okay.
Sorry, I didn't mean permanent, like you can't change it from 50,000.
Okay, I
Okay,
get it
I
now.
think that's where we went wrong. Okay, so this is the incorrect. I just want to be clear here. This was the incorrect journal entry, right? This was kind of, if you want to call it, the error. Sorry, the spacing isn't working so well here, but this is, this is the debit account. This is the credit account.
Got it.
This is incorrect. This is what you should have done, right? This is what
Yeah.
we should have done. And so we should have debited depreciation expense with 60,000, and we should have credited accumulated depreciation with 60,000. So we're $10,000 off. Do you agree with that?
Yes.
We're too low by 10,000 because depreciation expense to the income statement is now going in at 50, and it should have gone in at 60, right? So depreciation expense is too low by $10,000, making net income, right, too high,
Right. Got it.
$10,000, right? And that makes retained earnings too high by
Yeah.
10,000 as well, because net income closes to retained earnings. So now the question is, how do we fix this? Well, you're going to the next year now, so you can't, if you were still in the current year, you could go in and just make a journal entry, debit depreciation expense an extra 10,000 and credit accumulated for an extra 10,000. But because we are in the next year, we can't adjust excuse me, depreciation expense. What happened here? Okay, I see. Depreciation expense, because it is already closed. So we need to adjust retained earnings, because that's where it landed. Do you follow that piece?
Yes.
Okay, so now, because you can't debit depreciation expense, you debit retained, sorry, you debit retained earnings with the 10,000. Now the question is, what do you credit? Well, you could have still credited accumulated depreciation because it's a permanent account that doesn't close at all. The balance keeps rolling, so you are allowed to credit accumulated depreciation for the extra 10,000 that should have been recorded last year. And this is called the correcting journal entry. That's the correction that we need to make. Questions, more questions? Or are we, who was the Stuba? Are you okay? Was it two?
Yeah,
I
I'm
don't know.
good.
Are you good? Okay.
Yeah.
Other questions, people? All right. So that's the alternative way, or the full view of how we end up with this journal entry. And so the relationship is important here. If expenses are too low, net income is too high, retained earnings was too high. So to fix that, we will have to decrease retained earnings. If expenses are too high, net income is too low, retained earnings is too low, so we have to credit, meaning add, to fix this. And if it's an error in revenue, they all move in the same direction, because revenue is going to be this, like, go in the same direction as net income. If revenue is too low, net income is too low, retained earnings is too low, so you add. If revenue is too high, net income is too high, retained earnings is too high, so you subtract. All right. There's no question in the test that's asking you to, from a theoretical perspective, how does this work? It's more just you have to kind of understand these relationships, because the difficulty again with an error is that in order to fix an error, you actually have to know what should have happened, right, in the first place, what did happen, and then what's the impact of that, and then how do we fix that. All right. So if there aren't any more questions on this, I'm sure there'll be questions at some point in the future. Maybe we can look at, no, that's not what I want to do. Maybe we can look at an example. I'm clicking every sheet except the one I need. An example here to try and see if we can solidify this work. All right. So I am in the chapter 14 exercises. I don't know if you guys are coming ready with this stuff, but I just want to show you if you don't have it. It's this Excel spreadsheet, chapter 14 exercises, looking at number 7. Retained earnings. Remember I told you that my questions were still written like how the book was before, where it's actually asking for a retained earnings statement. The book moved away from wanting a full statement to just wanting, a balance calculation. But in order to get to the balance, we still have to consider a few things, to get there. So I'll walk you through this one quickly. Well, maybe not quickly, but I'll walk you through this one. So number 7, it says that this involves prior period adjustments. General Microwave has a retained earnings balance of $800,000 at December the 31st, 2017. So this is an ending balance on the retained earnings account. On which side of the account would this balance be, debit or credit?
I would say a credit.
Yeah, that's right. Because the normal balance of an account is on the side that the account increases. So a retained earnings account increases on the credit side. Therefore, the balance would also have to be on the credit side. So this is the ending balance at December 31, 2017. Now we go into the next year, January 2018. General Microwave discovers that it understated depreciation. Anybody want to guess what it means if you understate? Is it too low or too high?
Too low?
No.
Too low, right? So if you understate something, it's too low. This means that the expense was too low by $300,000 due to calculation errors. So if we go back to our little cheat sheet or whatever you want to call it, right? If the expense is too low, it must then mean that net income was too high in 2017. So retained earnings was too high. So to fix it, you will have to debit or decrease retained earnings. That's how these rules help you to answer the question. So the first question is prepare the journal entry for the correction of this error. So I'm going to, you know, I've shown you a journal entry now and shown you an example. So I'm going to throw it out to you guys to try to do the journal entry for the correction of the $300,000 error. I'm going to give you 3 minutes until 11:15. Don't scream out anything. Let's just give everybody a chance to make sure that they understand, and then we'll continue with the calculation of the retained earnings balance. Sorry, I've now spoken for a minute, so you can have until, well, 15 is fine. Okay. All right. So that's 15. So who wants to tell us what the journal entry will be?
Is it debit retained earnings by 300,000?
Yep. So we've got retained earnings debit because your depreciation was too low. So last year, so your net income was too low. Sorry, backtrack. Your retained earnings was too low last year, so your net income was too high, and therefore your retained earnings was too high. So now to rectify that, you will have to debit retained earnings. So
And credit cash?
retained earnings, not cash. There's no cash involved. Remember, cash is a fact. The only time you will involve cash is if there's actually money being paid or received. Remember this, what you have to do is accumulated depreciation. It's the same journal entry. It's just a different amount. So you're going to credit accumulated depreciation with 300,000 as well. Questions, guys? This is the first time to try this yourself, so maybe now the questions emerge.
Is it always accumulated depreciation?
If it's an error in depreciation, right, then it would be accumulated depreciation. Yeah.
Right.
If it's some other, some other error to do with an expense, then you would have to see what was the other side of the journal entry, so let's say you did some type of accrued expense and you did like salaries payable and salaries expense, if there was a mistake with that, then the other side would be salaries payable, right? So in this case, it's just accumulated depreciation because the error is actually related to depreciation.
Got it. So it depends on the account that is affected.
Yeah. And you kind of have to know, what journal entry would have been made in the first place. So I don't go overboard in the homework or in the test with, having to do all kinds of correcting entries. But this is a concept that is important. So that's also why I'm taking some time to explain how to get to these answers. Does anybody else have other questions about this journal entry or about the correction process in general?
Nope, thank you.
Okay, so that was, okay, so part one, let me just check the chat window. I haven't checked that in a while, sorry. I keep forgetting about this. Okay. Is the YouTube video for Monday's class uploaded? I was busy uploading it this morning. This is Shazid who's asking. Sorry, Shazid, I actually forgot to download it from Zoom on Monday because my office hour was so busy. I normally download it during the office hour, so forgive me. It should be, let me check. It was busy rendering. Yeah, it's up now. It was busy rendering early this morning, so it's there. I just hadn't sent out a note yet because I knew it was still busy rendering. So you can find it you should be able to find it in the playlist. All right, so the second part of this question, assume that the net income for 2018 is 650,000. Prepare the retained earnings statement for the year ended December 31. Remember I said we won't do a statement per se, but we will calculate what the ending balance on retained earnings is. So basically the way you do this is kind of just follow, the approach of what was the starting balance? Is there any adjustment that needs to be made? Was there any dividend, cash dividend, stock dividend? Is there net income? And then it gets you to the ending balance. So what I'm going to do is just write the stuff over here that I said. So what is the beginning balance, right? Are there any prior year adjustments? That's the second thing that you look for. This could be a plus or a minus. So, I can't say which way it will, this thing is gonna, hang on. Okay, plus or minus prior period adjustments. You're gonna add any net income, right? You're gonna subtract any net loss. Obviously the company can't have net income and net loss in the same year, but I'm giving you all the options of what could happen. Then you're going to subtract any cash dividend. You're also going to subtract any stock dividend. And then you come to the ending balance. That's how and what are we doing? Maybe if you forgot now what I'm even talking about, what we're trying to do is to calculate the ending balance on retained earnings. So what will be, based on this question, what will be the beginning balance that we're going to use? Anybody?
Is it 800,000?
Mm-hmm. So this beginning balance, we're talking about January the 1st, 2018, right? And so because they were asking us to calculate the ending balance at December, so it's for the year. So the January 1st balance is going to be the balance that rolled over from December 31, 2017. So that's 800,000, all right? So 800,000 is where we start.
Then minus 300,000?
Yeah, so that's exactly. So the adjustment to retained earnings is a subtraction for the prior period because we understated expenses, which means we overstated net income, overstated retained earnings in 2017. So in 2018, we have to fix that by saying minus 300,000.
And then 650,000 in net income.
Yeah, so now you're going to add the net income, exactly. 650 coming from the question, 650,000. There's no net loss, so you don't have to worry about that. Did they give us anything to do with dividends? No, right? It's a simple question here. No cash dividend, no stock dividend. So really, you're done. Where's the, see if this will work. Oh, I still have to punch in this stuff. How annoying. D1.
1,150,000.
Thank you. 1,150,000. All right. So that's how we calculate the ending balance for retained earnings. When you do this in the homework and when you do this in the test, it's normally just looking for one number, like the final number, which would be this. Okay. So when you're answering a question like this, they're just looking for the ending number. Any questions there? Anybody who's not clear how we got to something or needs further clarification? No? Okay, so apparently the explanation was perfect, right? All right, so just remember when you want to calculate the retained earnings balance, you may benefit from just trying to write down anything that could possibly affect retained earnings so that you don't forget something. Like I often find when students are doing examples like this, they leave out stock dividends because for some reason they think because it's a stock dividend, it doesn't affect retained earnings, but it does. Okay, remember I told you that the stock dividend is still closing out the retained earnings account because you are still distributing a portion of retained earnings, even though it's being distributed as stock. So you're basically exchanging one type of capital, retained earnings, for another type of capital, common stock. So here's another example. This is a very, in my opinion, fairly easy. Let me see if I want to give you this one or the next one. You know what? Let's have you guys do number 9. All right. So I'll give you, let's say 15 minutes to do number 9. I'll read it with you, and then you're calculating the ending balance. So number 9 says that Nevada Corporation has retained earnings of 2.1 million on January the 1st, 2018. So since they're asking you for the retained earnings balance at December 31, 2018, this is the beginning balance, right, on retained earnings. During the year, Nevada earned 1.5 million of net income. It declared and paid a $300,000 cash dividend. And in 2018, Nevada recorded an adjustment of 200,000 due to an error because they overstated depreciation expense in 2017. So you have to remember now, if expenses are overstated, too high, what happens to net income? What happens to retained earnings, and how do we fix that? So go ahead and follow this approach that we had before and calculate the ending balance on retained earnings. So you'll have 15 minutes from now. Don't scream out anything, just do your calculations, and then we'll take someone to give us the answer after 15 minutes. In the meantime, also ask me questions if you have questions in the chat window is fine.
Yes, sir.
Yeah,
Is there any way that you can help me with the first, the homework for chapter 14,
the
first
first
assignment?
homework, the first question.
Yeah. Uh-huh.
Let me just go in. I have to see how long it is, if we'll have enough time. I can't remember. I think it's not that long, but let me double check quickly. This one,
Yeah, on December 1st.
December the 1st. Yeah,
Yeah,
go ahead.
I'm kind of confused for the credits and for the paid-in capital and excess stated value. I don't know how to come up with that one.
Okay.
Yeah,
So the first, I guess the first point we have to remember is that the stock has a stated value of $4, right, per share.
yes.
So were you able to do April the 1st, because the process is the same? You understood how to do April the 1st. Hey?
Yeah,
Okay, so it's going to be the same thing. So basically, the way, I mean, the debit, you sound like you already understand. The debit is to cash, and it's going to
yeah,
be the 2,000 shares times the issue
yeah.
price, right? So it's in this example, I don't know if your numbers are the same as mine, it's going to be 40,000. And then the way you calculate the common stock is going to be the 2,000 shares times the $4, right? So that's going to be 8,000. And the paid in capital in excess of stated value is just the difference between these two numbers.
Oh, okay.
The other long way that you can calculate the paid in capital is to say, well, 20 minus 4 is 16, and $16 excess times 2,000 is also 32,000. But either way, you're
Oh,
going to come to the same answer, right?
yeah. I
You
got you.
got it?
Yes, thank you very much.
That's the only question you had?
Yes.
So the one thing that I will say, though, is when you do December the 15th, you have to remember that the number of shares is going to be what you started with,
Yeah,
plus what you issued in April, plus what you issued in December. Okay, so you
yes, I
got it.
got you.
All right.
Okay,
Okay,
thank you.
cool. We're still on break, so 2 more minutes for break, and then I'll start back up with income statements, okay? All right, so 11:54, so we'll start back up. The next piece of work that we have to deal with is corporate income statement. And basically, the income statement is going to look almost exactly the same as a multi-step income statement that you may or may not recall from accounting one. It's possible that you probably don't recall it. So I'll go over it in detail. But what I do want to highlight is that taxation, income tax expense is different here for a corporation than we had for partnerships or sole proprietorships, in that a company is actually treated as a separate legal entity, so they will be paying tax in their capacity. So income statements for companies are similar to those for proprietorships and partnerships, except for one thing, as I just said, companies pay tax in their own capacity and considered as a legal entity. As a result, companies have an income tax expense that's separate in the income statement. And when they do record income tax, they will have a journal entry which debits income tax expense and credits income tax payable. So as an example here, you can see, and this is illustration 14.18 in the income statement, typical financial statement, the name of the company, the name of the statement, and because it's an income statement, it's going to be for a period of time. So it's for the year ended December 31, 2020. And then you start with normally with revenue, and this is what I mean by the multi-step, because the multi-step income statement also deducts costs of goods sold. So you've got sales revenue, you subtract cost of goods sold for 600,000 to get to a gross profit of 200,000. And then you're subtracting operating expenses of 50,000 to get to income from operations of 150,000. So that's the 200 minus the 50 is 150. And so these other revenues and gains are added, other expenses and losses are subtracted. Does anybody want to venture a guess as to why this thing is called other? Why are these called other expenses and other revenues? Any takers?
The additional?
Yeah, but more so than that. Why use the word other? Because you could just say additional revenues, gains, or what's the other supposed to represent?
Their extra earnings?
Well, which is the same if we
Same
say
thing, right? Sorry.
so other, you're going to know this now when I say it, because you guys may remember this from accounting one, that other is non-operating revenues and gains and non-operating expenses and losses. So up to now, or up to here, you've got income from operations, right? So that means operations means the day-to-day activities of the company. And so yeah, when we start talking about other, that's going to be non-operating, right? Non-operating revenues and gains, non-operating expenses and losses. So the 150,000 positive income, you add 10,000 because revenues and gains are obviously an addition, but then you have to subtract the 4,000. So that's going to get you to income before income taxes of 156,000. And it's on this number, the 156,000, that we calculate income tax. So 156, and then they've got an income tax expense of 46,800. So who wants to calculate? Someone tell us what the percentage of tax is that this company is paying. What percentage of tax is this company paying? No takers? That's okay. I'll help you. So if you want to calculate, you can say, what is the income tax expense? Sorry, income tax expense. If you go back to the question, that's going to be 46,800. What is the income before income tax expense is going to be 156,000. So if we divide this, you're going to say 46,800 divided by 156.3, which also is 30%. Is there any company that is still paying 30% tax these days? What do you guys think? Yes or no? Are
No.
companies paying 30%?
No.
No. Right, the answer is no. The corporate, this was last year, the corporate tax rate was decreased to what? Does anybody know? In 2019, it was decreased to 21% in 2019 from supposedly 35%, but honestly, no companies were paying 35% either. I mean, these companies employ very smart tax people and lawyers and stuff that help them to find what we call loopholes in the tax code that allow them to pay sometimes effective tax rates, and this is what this is, the effective tax rate. Sometimes an effective tax rate that is way lower than even we pay as individuals. So, you know, you can find companies having tax rates as low as 11% when you and me working day to day have tax rates like 15%, 20%, sometimes even 25%. So individual tax rates, I think, go as high as approximately 36%. So again, for a corporate income statement, the big difference here is that you would have to calculate an income tax expense, and then you subtract that income tax expense from income before income taxes to get to net income. All right, get to net income of 109,200. Questions on the format of the income statement before we do an example of that? Okay, so let's go and look at a quick example. I'm going to skip over this example. I'll come back to do the calculation for return on stockholders' equity. So let's just do number 11. The following information is available for Range Corporation for the year ended December 31, 2018. They have cost of goods sold of $205,000. They have sales revenue of $350,000, other revenues and gains of $50,000, and operating expenses of $75,000. Assuming a corporate tax rate of 30%, which again, like I said, this is reduced over time, but for now, you know, we're just going with what the question says. Prepare an income statement for the company. So I'll do this one with you. Again, this is example 11. So the first thing and you'll have this already in Wiley, but the first thing I'll put down is the name of the company. And we'll put income statement. And then it's going to be for a period of time. So it's going to be for the year ended December 31, 2018. All right. And so now where do we begin? With the first thing that was said here, cost of goods sold, or with something else?
Sales revenue.
Yeah, so you go back to your example and you say, okay, we start with sales revenue. And you're going to look for the amount over here is $350,000. And so now the cost of goods sold is next, because remember, this is a multi-step income statement. Multi-step meaning that there are a number of steps, a number of additions and subtractions before you get to net income. It's not just sales minus expenses is net income. That would be a single step. So the multi-step requires some additional work from us. So cost of goods sold is 205,000.
Next is gross profit.
Yeah, the answer here is going to be gross profit. Try to get rid of this dollar sign. Just get rid of this line also, sorry for all that. All right, so this is gross profit. So when you're making an income statement, remember on the test, I'm just going to take a sidebar here quickly. On the test, the last question is the income statement. So, you know, just make sure that if you don't think you're going to remember all of the names, the order of the names or whatever, that you have the book close by so that you don't get flustered with what comes next. Remember, I told you that if we were in class, I would be giving you a template. So, you know, my aim is not that everybody has to memorize all the stuff. That's not the point. The point is to understand the mechanics of, you know, of how to do this. So operating expenses is next. You're subtracting the expenses that the company incurs day to day. In the business. So operating expenses over here are 75,000. So that's the next thing that you will attack. And after you subtract operating expenses, you come to income from operations, because it's saying just by being in business, this is the amount of money that we make. So under normal circumstances, this is what someone is making. And so now if we look over here, we see that there is still this other revenues and gains. If you go back to the format that we're following from the textbook, that's going to be the next item. We don't have other expenses and losses. So other revenues and gains. And for that, we're going to say 50,000. All right, 50,000. No other expenses and losses. So you don't have to write this line in, you know, if it's 0. So you're going to come now to income before income taxes. And so these two numbers are added because it's income plus other revenue. So that's 120. And now we're going to say income tax expense. And based on the question, the corporate tax rate is 30%. So take a minute, 30 seconds or whatever, and calculate on your calculator how much you think. You don't have to scream it out. Just let everybody have an option to calculate it. Calculate what you think the income tax expense should be.
$36,000.
Hey, I said don't say it.
Yeah.
You're bailing out people who are still trying to find their calculator.
It's like it's like when I'm about to write the answer, he just calls it out.
Okay, so we will practice grace and say next time. Okay, don't say anything until I call for it. So 36,000 is in fact the answer. And now the last line is net income.
Professor, I didn't get 36.
Okay, what happened? Tell me what you got.
Wait, I'm lost myself. So wait, hold. So in order to get the income tax expense, you took the income before income tax, right?
And
And
then
then
because the question said that it's 30% income tax rate, I applied
oh,
the
okay, okay,
30%.
okay.
What
I
did you
didn't see
do?
that.
Huh?
I was trying to figure out my own percentage. That's why I was getting a wrong answer.
Oh, no, the reason we calculated a percentage before was because they already gave us the answer. So I was just trying to see if you guys could figure out what
Oh,
percentage this
okay.
represented. Yeah, under normal circumstances, you wouldn't be able to calculate the percentage. They have to give it to you because they're not giving you the answer.
Yeah, because I
Right?
was like, how did he do it so fast? Like I'm still trying to work it out.
Oopsie. Did you see in the question, though, you recognize here that it says 30%?
Yeah, now I see it. I
Yeah,
didn't know. I
yeah.
didn't know it was
Okay.
there.
Okay, so it's in the question, and then once you get the number, you subtract the 36,000 from the 120,000 income before income taxes to get to net income of 84,000. Questions on any part of this income statement? I'm just giving, for anybody who still needs time to write this down, I'm going to give you time to write it down. Then I'm just going to go into the homework for chapter 14. I just want to show you that there's a similar question, excuse me, near the end of the homework. Maybe this is better if I actually write 30%, just to make it really obvious. All right. So I'm just going to go into the homework quickly. And so Christania, I didn't see your question before. So on the test, the order is going to be the same like this. Yes. And someone else also, Christania in conjunction with Shazid, were asking about the YouTube video. It's already on YouTube. I forgot to do it on Monday afternoon. So it's there. If for some reason you're having a problem not seeing it, let me know. But I only put it up this morning. Okay. Let me go into assignments quickly. I will share my screen again.
Professor.
Someone's calling me? Yeah.
Yeah, Tiffany. When you said in order, what did you mean by that?
Oh, she was asking if it's going to look the same, basically. Like, will you have to write it out like this for the test?
Oh, okay.
Yeah. So I was saying, yes, it's not going to be like some new fancy or different or something order. It's the same thing for the test. All right.
Okay.
So yeah, this is the last question on the homework 14-12, and basically it's the same thing like what we just did before, except that there's also expenses and losses. What Wiley's saying here is, to this point about should there be minus signs or not, they'll accept positive and negative. Yeah, it doesn't matter. Just looking at the question itself, you see they give you the sales revenue, they give you other revenues and gains, operating expenses, cost of goods sold, other expenses and losses, and preferred stock dividends. So I want to just stop and talk about preferred stock dividends because it's also going to come up in the next question where we do earnings per share. A dividend is not an expense. So you do not subtract dividends on an income statement. A dividend is a distribution of the net income, which is the final number on the income statement. So I just want to be clear that the preferred stock dividend amount is given, but it's not needed for this part of the question. It's needed for when you calculate earnings per share, because net income, right, is monies that could be distributed to both common stockholders and preferred stockholders, but earnings per share is a number related to common stockholders only. When we calculate earnings per share, we have to subtract the preferred stock dividend. I'll go over this in detail in a minute, but I just want to make sure you understand that you are not deducting the preferred stock dividend anywhere on an income statement. And then also, you can see here that the tax rate is given at 25%. So this income tax expense, you would calculate as the income before income taxes multiplied by the 25% to give you the income tax expense, all right? And the shares number that's given is not needed for the income statement. It is needed for the earnings per share calculation. Does anybody have any points of clarification or questions on what I just said here for this homework?
Can you please just briefly go through it again, but like really quick?
Is there a particular part of it that you need me to
So
emphasize?
you said that two
Can you
of the
repeat that part?
points.
Sorry.
You said that the points that they are giving in the.
Oh, yeah. So the preferred stock dividend thing, is that what you're talking about?
Yeah. You said
Yeah,
that
so-
that is just needed for the second question. And what is the other thing that is just needed for the
Yeah,
second?
okay. So the preferred stock dividend, my first point is that no dividend ever shows up in the income statement, right? Because a dividend is not an expense, it's an allocation of net income. So this number, preferred stock dividend, is given to assist you in the calculation of earnings per share. And the earnings per share calculation, I'll show you guys in a minute in our notes, but it's basically got to do with net income, but you have to subtract the preferred stock dividend because earnings per share relates to common stockholders. So you don't want to overstate how much money they've earned, because some of that money has to go to preferred stockholders. So you'll need this preferred stock dividend number for earnings per share. The other thing that I said was that the company's tax rate is 25%. So you have to apply that to income before income taxes to get your income tax expense. And the last thing that I said was the 46,000 shares definitely also does not come up in an income statement. You would never put a number of shares in the income statement. What you do need it for is the earnings per share calculation.
Got it. Thank you.
Okay. Somebody else was also trying to speak at some point during this conversation. Is that person okay? I couldn't hear who that was.
Yeah, that was me, but you already went through it.
You went through it? Okay. So you're good?
Mhm. Yeah, thanks.
All right, cool. Anything else, people? All right. So hang on, let me go back here to the notes. You can also just check. Okay. So when we come to now to the two, remember I said there's two calculations that we still have to cover before we finish up this chapter. You've got the return on stockholders' equity and the earnings per share. Both of these calculations relate specifically to common stockholders, not to preferred stockholders, all right? So that's why every time you'll see when we do the calculation, there's a subtraction of anything that belongs to preferred stockholders, in this case, specifically preferred dividends. So let's just go over the theory. The return on common stockholders' equity shows you how many dollars of net income the company earned for each dollar invested by the common stockholders. So it's calculated as all the net income that the company earned for the year, but subtract any preferred dividends, right? Because that doesn't belong to common stockholders. And then you divide that by the average common stockholders' equity. We know what stockholders' equity is, right? It's the balance on whatever amount the common stockholders contributed. Average is, and I'll show you this in our calculations in a minute, average is always just going to be, and I'll just write it here, so in case someone wants to take it down, average means the beginning balance plus the ending balance divided by 2. All right. So we're talking about the beginning balance on common stockholders' equity plus the ending balance on common stockholders. So beginning balance could be something like the balance on January the 1st, right? Just to make this really obvious. And the ending balance would be then on December 31st divided by 2. So you're taking the average of that, and the numerator, the top number, is net income minus your preferred dividend. Question on this theory before I show you an example.
Can you please just stop there for a second?
Yeah, I can stop, and I can. You guys can tell at any time. Tell me to slow down. Don't be shy.
Okay, thank you.
All right, so we can go on to, excuse me, to example 10, which is going to be a calculation of the return on equity using this formula. So if you, again, you know, I just want to keep going back to when you're sitting doing the quiz or doing the test, if you know that there's going to be a potential, I mean, you may not know that there will for sure be a question that that asks you to calculate this, but you should be sitting with your documents near to you, because I don't expect you to memorize these formulas. In fact, when we, you know, if we're face to face, I normally give a formula sheet, because my interest is not so much in you just memorizing a formula, but my interest is in whether you know how to use the formula and you understand what it represents. Okay, so when you get ready to sit and do the homework or sit and do the quiz and the test, feel free to make sure that you have this handout or something close by, so that you don't have to run around trying to find the formula, or even try to remember the formula for this calculation. It's not necessary. You just need to know how to apply the stuff for my purposes. So we're looking at number 10. All right, number 10, Walt Disney Company's beginning and ending stockholders' equity were $31,820 and $30,753, but it's in million, so it's actually billion, respectively. Because everything is in millions, you don't have to add the 6 zeros. You can just work with these numbers, right? All these numbers are in millions already, so you can just work with 31820 and 30753. So it's telling us that the beginning number was 31 and the ending number is 30. Why do we need that? Because when you go back, remember, we take the average of stockholders' equity. So we do need the beginning balance and we need the ending balance. We will add them together and divide by 2 to get to the average. The net income was 4687. All right, so the net income goes at the top over here, and now we have to check if there were any preferred dividends. No preferred stock was outstanding, so because they don't have any preferred stock, there's also not going to be any preferred dividend. Compute or calculate the return on common stockholders' equity. All right, so if we go in, we're saying what is net income, right, minus the preferred dividend and you're going to divide that by the average common stockholders' equity. So we might as well start by calculating, why is this thing acting up? Okay, calculate the average common stockholders. I'm just going to abbreviate it, stockholders' equity. That's going to be the numbers that we were given. So 31,820 and 3753. So I'll just do the formula over here. 31,820 plus, forgot the number already, plus 30753 divided by 2. Okay, so 31,820 plus 753 divided by 2. That's how I got that number. So that's going to be my average. All right. And then net income minus preferred dividend. The net income was given as 4687. So 4687 minus 0, because there's no preferred dividend, divided by 31,286.5. So what does that come to? I'll have to calculate it over here. 4687 over 31,286.5. So that's what that number looks like. Does anyone want to guess what that actually means?
50%?
15, did you say 15%?
15%.
Yeah, that's right. So the return, whenever you hear the word return, it's generally expressed as a percentage. So in this case, you end up with this 0.14, but you convert it to a percentage, so it's 14.98, or if you round to no decimals, it's going to be 15%. So what does that mean? We say that for every, and you won't have to write this on the test, but for every dollar that common stockholders invested, they earned 15 cents in net income. Right? So for every $1 that you put in, your return is 15 cents. Now the question is that good, bad, or ugly? It depends on what they could have earned elsewhere. It depends on what they expected to earn. We don't know that, but we do know that they earned 15%. In these days, if you got 15% back, it's pretty good, considering that if you just left your money in the bank, interest rates are basically 0. So you're doing much better. But of course, you know, if you invest in a company like you're investing here in Walt Disney, right, is the name of the company, in their stocks, you take on risk, right? Because anything can happen with this stock. So let's see if we look at the Disney stock. Where's it trading right now? $101 per share. Over the course of 6 months, they were as high as, you know, well, 132 was high, but I think at their peak, like 145. Right now, they're down to 101. So, you know, the higher the risk, the higher the return people are expecting, because if I'm putting my money in here, I stand to lose, or I could stand to lose quite a bit, you know, and so I expect my return to be higher. But many of these stocks, you know, over time, the price does go up, especially if it's a good company. So 15% return, that's return on equity. Now, if we have to talk about, if we have to talk about earnings per share, it's over here at the end. Earnings per share is the last ratio that belongs in this chapter. So basically, we're just saying for every share, so now not the average common stockholders' equity, but the average shares outstanding. For every share that a common stockholder holds, right, that they own, how much money has been earned, right? So this is an actual dollar amount. The previous calculation was a percentage. This is a dollar amount. So let's look at example 12. Assume that Raleigh Inc. reports net income, there's the net income number, of $211,000 on its 102,500 weighted average common shares. So let's go back and see if this makes any sense. So there's the net income, right? They gave us a net income number. They also already gave us the weighted average common shares outstanding. Weighted average just means you take into consideration all the shares on average that were outstanding during the year, including shares that may have been issued during you know, at various points in the year. So you have the number that you need already. Now the only question is, was there a preferred dividend? And it says yes. it declares a $6,000 dividend on its preferred stock. So calculate the earnings per share for common stockholders. Again, this is going to be a dollar amount as opposed to a percentage. So here we go. Example 12, you're going to say, what's my net income minus any preferred dividend? Again, the preferred dividend is subtracted because these ratios relate specifically to common stockholders. So we have to remove anything that doesn't belong to common stockholders, divided by the weighted average common. They say stock or shares? I can't remember what. I just want to follow common shares. Sorry, shares outstanding equals earnings per share. So we've got net income of, it's very easy, right? You're just basically putting numbers into a formula. So net income is 211,000 minus the preferred dividend of 6,000 divided by the common stock outstanding 102,500. So that's your formula, right? And that's going to equal, I'll just do the math with a proper formula set up over here, 211,000 minus 6,000 divided by 102,500. So it's 2. So therefore the earnings per share, the EPS is $2 per share. So for every share that a common stockholder owns, they earned net income of $2. So that might sound low, but if you own 1,000 shares or 10,000 shares, you multiply each of those by $2. It's a decent amount of money. But does this mean that they actually get paid out this money? What do you guys think? Will the company actually just pay out all this net income as dividends? Yeah, exactly. Not necessarily. The stockholders will only get this money as actual cash if the company declares and pays a cash dividend. So remember I told you for all the years the stockholders of Apple were getting so mad because Apple was making all this money and they had all this high earnings per share, but they refused to pay a dividend. So so sometimes there's a level of frustration because you see how the company is making money, but you are not getting the money in the form of a dividend. Questions on the calculation of earnings per share? All right, so I'll come back to that page because maybe some people are still taking stuff down. Let me see, I wanted to see if we could look at, so if I look at the most recent financials for Amazon, and I look at their, I'll show you now just quickly. If I look at the income statement, which they call the statement of operations. This is not where I need it to be. Oh, it didn't jump to it. Okay. You can see over here, I just want to show you how these things show up on the financials. So there's the net income that we were talking about, right? In 2018, Amazon made $10 billion in net income, which was up from $3 billion in 2017. 2019 will be higher. Those financials are probably out by now. And just so you can see here, the earnings per share was $20.68. Did they declare a dividend of $20 to anybody? No. All right. So if you're holding stock in Amazon, you can see, oh wow, I earned a lot of money, but it kind of doesn't matter at this point. It's, the stock price is increasing, but I'm not actually receiving any of that money at the moment. And I'm sure, unlike many other companies that are suffering in this pandemic, Amazon is actually doing really well. So I'm sure that 2020 will be an even bigger year for them, whether we like it or not. All right. So that's earnings per share. Are we good here? Do people still need time to take stuff down here?
Yes, just give me like a minute.
Yeah, take your time.
Professor, did we jump the exercise 9, I guess? 9, 8.
No, we didn't jump over it. We did it. It was the income statement that that I did with you. It's just higher up.
The 8 one?
Are you asking me? You're asking me about example 9, right?
Sorry, no, 8.
Oh, I jumped over that. Yeah, because number 8 is even easier than number 7 and number 9. But the solution for 8 is in the solutions sheet that's on the solutions tab in Blackboard.
Okay.
Yeah, because that question is just net income and dividends and a beginning and ending balance. So you can do it fairly easily.
Got it. Thank you.
I'm done, Professor. It's good.
Anybody else who needs me to just pause for a minute here? No? All right. So that concludes chapter 14. So you guys are fully equipped at this time now to complete the homework. I'm not going to start going crazy into chapter 15 because one, we don't have that much time, and two, it's not really necessary right now. But I just did want to give you a preview of what chapter 15 is about. So up to now for 13 and 14, we've been dealing with companies raising money through issuing stocks, whether common stock or preferred stock, right? So the debit is to cash. So basically the company is getting money and they're giving out ownership, right, in the company to people on the outside. Another option for companies, instead of raising money by giving away parts of the company, is actually to borrow money. So in chapter 15, we're going to be dealing with borrowing. So that's the chapter is called long-term liabilities. So it's not just borrowing, in the short term where you just take out a quick, 3-month loan, or you're just using a credit card or something like that. This is talking about borrowing where you will have to be paying interest over a number of years, and you will also have to pay back the borrowed amount at the end of the time, the term of whatever borrowing you're doing. So some of the highlights in this chapter are the fact that we will be working with different types of debt. So the first thing that you'll see is bonds payable, which is a type of borrowing. There's also interest calculations. So you will need to know or remember, and obviously I'll show you how to calculate interest either for a whole year or part of a year. We're also going to be dealing with bonds that are sometimes sold for less than what the person pays back at the end, or for more than what's paid back at the end. How do you account when the bond is paid off before the time or at maturity? What happens if the bond gets converted to common stock? And then also there's other parts to do with mortgages. Like if any of you have a mortgage, you would know that when you pay off your mortgage every month, part of it is the actual balance that you're paying. The other part is interest. So we talk a little bit about that as well. And the last part in this chapter is about leases. So if you're renting your apartment, you know that every month you pay rent. So we talk about that, which is an operating lease. And the other piece is a capital lease, which is a lease, but you are almost in effect the owner of the property. So that's what's coming in chapter 15. I just want to show you, I did, if I'm not mistaken, sometimes these things bleed into each other. Yeah, I did. I should move this up. I did put for, put for today already the chapter 15 notes and stuff that we will be referring to more on Monday when we get together. I just want to remind you, not that it maybe makes a huge difference to you, but I don't want people to get a shock when I end the call early. I told you on Monday, and I'm telling you again today, that our call on the 27th, which is this coming Monday, I have to end early at about 11:50, 11:55, because I have a mandatory meeting. My department has a mandatory meeting with the president and the provost of the college. So we will only have about, an hour and 15 minutes or thereabouts. So please plan to be on time because we have to end early. And at that point, we will start getting into chapter 15, but I'll also be, the meeting is just from 12 to 1, so I'll definitely be online for my office hours, because I'm sure people may have questions at that point to do with chapter 14 homework, or even to do with test prep. Okay, so anything else about the test or about chapter 15 or 14 before we end?
Yes, I wanted to ask you for the test. It has to be like straight up, right? You can't just save it and start. Excuse me.
No, you can't. So that's the struggle, with these timed tests and things, is that you will have to do it in one shot, which is why I'm saying that I'm giving you guys, a window of a week to do it in, because then, I don't want to give it just on one day, and then maybe that's a day when you don't have enough time to actually finish it. But
Okay.
unfortunately, when you start, you are going to have to just get it done in that time. I gave you guys, this already, I gave you 4
Yeah.
hours in the hopes that will at least alleviate the burden somewhat. But if for some reason when the times when you can go back in is if you got kicked out for some reason, then you contact me, and I will make sure that I get you back in. The problem just with the being kicked out thing is that sometimes, depending on where you were in the process or what's going on with the system, when you get kicked out, you could actually end up losing. Like, I cannot, sometimes I can't manipulate the situation to preserve the work that you did already. Sometimes I can try to take a screenshot to at least give you the points, but the problem is if you wanted to go back and fix something on an old question and I can't preserve your work, then you have to start again. But
Okay.
if that happens, I normally reset the time down back to the full amount of time so that the person can start from scratch, basically. That's really, because I think, it's, I don't know, Wiley can be very fickle, because sometimes it lets me reset, let you go back in and your work is actually saved. And other times it says the only way you can go back in is to wipe out everything. And I can't get a clear answer as to when, which scenario applies. So that's the only risk of being thrown out. If I can get you back in, you may have to do everything over.
Okay, and also you don't have to do the quiz and the exam at the same time, right? Like
No. Yeah, the quiz is a totally separate thing. It's 10 multiple choice questions. You have 2 hours. You have, for both of them, you have 4 attempts. But remember, for the quiz, don't guess, because once you get to the 3rd attempt, your point potential drops
Yeah.
60%. But and I encourage everybody to do the quiz first, because the quiz, the 10 questions on the quiz are related topics to, the major exercises on the test. So if you are, you have a multiple choice question, the answers are basically in front of you and you're really struggling, then it's going to be an indicator of which areas you may want to spend some more time on.
Okay, all right. Thank you, Professor. Thanks.
All right. Other items, folks? All right. So then if we're done, you guys are dismissed. Please spend time on the homework and so on, and contact me with screenshots if you have issues. And if you still have questions for me that you need to ask in private or something, you can stay on the line. I'll still be here for a few more minutes.
Thank you, Professor. Be safe.
You too. Bye-bye.
Thank you. Take care, everybody.
You too.
Thank you.
Bye.
Thank you,
Bye-bye.
thank you, Professor. Have a nice
You're
day.
welcome. Bye.
Thank you, Professor. See you.
Thank
Bye.
you.
You're welcome.
Professor, which are the other classes you give?
This semester,
No, in general.
all the accounting, more so accounting 2 and intermediate 2, and then I give the first year seminar also, and then I mentor the finance club. Those are basically the main things that I do.
Got it.
Mm-hmm.
Thank you.
All right. Bye-bye.
Bye.